Ken to the stage. As CFO of Smurfit Kappa Group, Ken has extensive experience in sustainability reporting and sustainability development. Ken will talk today about the Smurfit Kappa sustainability story and look at how the market is impacted by and reacting to sustainability and ESG requirements. And finally, he will see how these changes impact the annual report. So, without further ado, Ken, thank you very much.
Thanks, Martin. Good morning, everybody. It is great to be back out, but the jackets don't fit like they used to back in 2019. Listen, really thanks for the opportunity to speak, because sometimes I think in this particular world, it's the voice of the corporate gets lost between the needs of other stakeholders, particularly the investment community and their wants, boards and their wants, and what the European Union wants at a fundamental level. I suppose the first question you might ask is, how come the CFO gets to stand up here and do this? It's not really their remit. Well, as you'll see from the organisation I work for, you can't be in Smurfit Kappa unless you believe in sustainability. It's just the nature of what we do. But quite simply, we took a view a couple of years ago that what was coming down the track in relation to sustainability probably sat better with myself rather than Tony. That doesn't mean Tony has absolved his responsibility for ESG. He just gets not to have to do the really hard stuff about putting systems and processes and everything else in place. Equally, outside of my role as CFO in Smurfit Kappa, I'm a member of the European Roundtable of CFOs, which has direct interaction with Mairead McGuinness and the Commission on the taxonomy. So I've had I'm not going to say a few rows about that one. And I'm also a member of Accounting for Sustainability in the UK, which is now King Charles's, but Prince Charles's charitable trust, which is very active again in lobbying around sustainability. So today I'll talk a little bit about our journey, and our journey is probably slightly unique. We have been doing it a lot longer than others, but I think the takeaway here is we don't have it right. There is no perfection, because we are building systems and processes on very shifting sands, and the foundations have not been set for us, which is something accountants absolutely hate. All right, so you cannot have, the starting point is the most difficult piece. And it's a world that requires transparency, disclosure and data. But again, and to Lisa's kind of presentation, none of that said either. And Lisa did a fantastic setup for all the problems that I'm going to talk to you about. And I really hope that this is kind of bulletproof by the time we get to the end of it, because, but Kevin made a point, and I think that's the important point here is there is value here. And opportunity here for organizations to properly position themselves in a world that needs sustainability and wants to invest in sustainable organizations is real. But you've got to be credible in that kind of journey. And it has to be a journey based on data, facts, and transparency, and not something else, greenwashing or anything else. So a little bit about Smurfit Kappa and our journey. I suppose our journey started back in 2005. And we've been doing assured reports since 2007, so way before anybody else even thought of it. And that wasn't because we had some great foresight into the way the world was going. It was actually because our largest customer at the time, it was Unilever, said, we need you to report on your carbon targets and the reductions, because we need to report on those to our customers. That's 2005. So if you want to think about the level of progress we've made in the 17 years, not as a company, but as a globe, you can see how little that is. We're still only talking about the starting point around carbon reduction targets, adaptation, capture systems, everything else. Yet it's been a conversation in our organization for the guts of 20 years now. Except nobody really wanted to listen until the problem got ever more increasingly worse. And until people began to realize that the only way you were going to solve this problem was through regulation. So for those who kind of don't know Smurfit Kappa that well, ultimately we're a circular economy business. And Lisa talked a little bit about double materiality. Our model is a double materiality model. So we focus as much on what we leave behind in nature as what we take from nature in the first place. Our product is renewable, recyclable, biodegradable. It'll disappear back to nature very quickly, which distinguishes it completely from plastic or anything else. We're not anti-plastic, we're anti-waste. So our job is to collect post-consumer waste and turn it back into beautiful boxes. And we'll see those boxes roughly 10 times in the cycle. It's also important to, this is where we get to the conversation around the European Union's wants and needs. The European Union wants to push on a reuse model. A reuse model kills the packaging industry for fiber-based packagers. We can't reuse our product in that way. We have to recycle it. So we're very active, again, with the European Union, trying to get them to kind of understand that actually reuse is not the model. Think about recyclability, biodegradability, and renewability. So that screen will tell you a lot. What that basically says is that we collect 7,500 tons of post-consumer waste. So all the stuff you bought during the pandemic that went to your doors, we took back and made back into boxes, not for Amazon. We do different kind of customers. All of that goes into paper we make, and all of that goes into boxes we make. So when we talk about that kind of value chain and supply chain for things like CSRD, we're better set because we can actually go back to the fiber source and collect that fiber source again. And actually it was the basis on something I'll talk about later, which was how we raised a green bond last year around the circular economy. We have a little bit of forestry in Colombia. And actually, oddly, that's the only part of our business that's aligned with the EU taxonomy and the only eligible parts. So if you think about we're a 10 billion market cap, we're FTSE 50, and the only part of my business currently aligned with the taxonomy is my small forestry plantation in Colombia. And I don't get to talk about the rest of my business. So investors will say to you, but surely if you're not aligned, that's a problem. You say, no, it's not a problem, it just isn't. So I've had a conversation with the commissioner to say, look, you got to allow organizations to kind of elect in before this gets really difficult for organizations to defend, where investors will go, if you're not aligned, you're out. If you're not aligned, you're in. And those days are kind of coming. So our business is basically scope 1 and 2 in terms of emissions. So 65% of our emissions are really driven by our paper mills. 35% are scope 3, transport on the road and everything else. Oddly enough, our customers' emissions are all scope 3. So when you think about our FMCG customers, all their emissions are scope 3, 90% plus, 95 in some cases. So we become a fundamental part of their carbon reduction targets. And we don't get to capture that in our carbon reduction targets. That's their story. But it kind of shows you where fundamentally something like a fiber-based packaging company sits at the heart of a sustainability journey and story, because you really can't do it without us. And there's one number that we don't get to capture on that screen, which is that if we don't do what we do, if we don't collect all that waste, it requires an additional 7.5 million tons of carbon annually to be emitted. But I don't get to capture that in my numbers either, or I'd be carbon positive already. And we are kind of an acknowledged leader in sustainability. We do it across the regulatory pillars: people, planet, and impactful business. And it really goes back to the heart of people. And one of the things you should realize, if your organization is not set up to deliver sustainability from the individual level, you're never going to do it at the corporate level. We think about sustainability in the context of talent attraction, retention, and development, because they're the questions that our talent ask us around the organization we are. So when we talk about greenwashing, that can happen on the talent field as well. So the organization you're trying to build and hire from a talent perspective should equally have the same credentials and beliefs as the one you're trying to portray to the external market, or else it will fall apart fairly quickly. And the S, as you can imagine, has become ever more capitalized, I'd say, over the last few years. I think we're now beginning to see those organizations that didn't necessarily treat their people well, if you like, during the COVID years, are now beginning to see that impact through the Great Resignation or the Great Revaluation, or the quiet quit, whatever you want to call it. But we do see sustainability not just as something we do externally, it has to be internal. And that really drives kind of engagement, and it drives people's desire to work with us. But we do also have a set of external targets that we measure ourselves against. And these are only in recent years, because we've been doing this, not forever, but close enough in the world of sustainability. But it's only in the last number of years where people needed us to kind of publish our targets and needed us to kind of say where we're going. So all our targets go back to the Paris Agreement in 2005, which is unusual in itself when you get to, we see later on. And all are based around people, planet, and impactful business. And as you can see, all are aligned in some way to the SDG goals. One of the questions that was asked about CSRD and GRI, you will probably be able to reconcile it. It'll be a nightmare. But in the case we use GRI Plus, and we get to reconcile that to TCFD, which is a nightmare in itself. But we're sticking with GRI because we've been doing it forever. Not going to change now. What's interesting about this page is that there's a target on there for water reduction. We don't actually use any water. But the problem was we were being screened out of indices because we didn't have a water reduction target. So we created a water reduction target, and then we got screened into the indices. We're a water processor. So all the water we take in, we send back cleaner than it came to us through wastewater treatment plants. But we couldn't understand why, particularly in this, they said you don't have a water reduction target and you clearly use water. So we don't use water, we process water. So this is the kind of world that you enter into, which is, unless you understand the requirements on the far side, that's one index. Other indexes don't care. So we've built this to kind of not only have real targets, but actually to be relevant to the kind of indices you're trying to attract. But there's two pillars beyond this, really. And if you like, this is the operational targets pillar. The organization we're trying to build is one that, irrespective of where you meet Smurfit Kappa, you see a green company. So when I talk to Kieran and Frank and our IR team, I don't want the first conversation to be around growth and the pricing of recycled fiber and the price of a box and paper. I want that conversation to be around sustainability and what you're doing as an organization. They can find out later on and make a view on whether they like your product or not. But it's got to be a different kind of conversation. So we've also spent the last number of years building out the capital structure in terms of it being green. So if you like, 22% of our share reg is what you'd call green, which is the largest in our sector. We're not there yet, but it shows that there are some kind of traction. Some traction is being made around who you can bring onto your register if, again, you tell that story effectively. More importantly, I think, from the debt perspective, our entire capital structure from the debt perspective is now green. So we greened our revolving credit facility is directly linked to these targets and their achievement. And there clearly is, the margin will change if we don't achieve them. And that's going to get difficult for a lot of organizations because of the impact on Russia on all these targets. If you think about forestry in Russia and it's kind of transport into the European Union, all that wood is now controversy wood. You can't take it anymore. Chain of custody gets suffered. So these targets will suffer for organizations, and they will miss, and they will see higher margins on things like revolvers. Equally, we went out this time last year and raised our first green bond for €1 billion, 2 tranches of 500 at 50 basis points for the 8-year and 1% for the 12-year. Today, that would be about 5%. So clearly a fantastic piece of work done by our treasury team. But more importantly, 75% of those bonds were taken up by green or dark green investors, and it was 7 times oversubscribed. So the appetite's out there for companies who can, and like I say, we're not perfect, companies who can tell their ESG story in an effective way, target-based, and with a journey behind it. People will kind of row in behind that. So again, do we feel that we're kind of there yet? No, but the organization now is greener than it might have been before. So it's important to kind of step back a piece and think about the current landscape we're seeing and maybe the evolution of that from my perspective. If you're like, what do I consider to be the goal in hand? And really, over a number of years, we've seen this evolve. So you go back 4 or 5 years, you had ESG people in the room, but they had no money to spend. They couldn't put the money to work, or if they could, it was in very small amounts. So they were the last question you got as you went to the elevator after you'd gone through all the hedge fund, the fixed income guy, the controversy fund, the long guy. They'd all had their questions. The person in ESG got to ask their question as you went to the elevator about how do you feel about your water reduction target. They don't have one because I don't. Anyway, we go back to that again, but the money's coming in, and you can see it. And while the quantums are different in the US, the trajectory is the same. So there clearly is money to be spent and played at in this world. And what was pleasing, if you like, from if you can have any pleasing aspect to a share price drop of 30%, is that where we saw resilience actually was in Article 9 funds. So pure ESG players around Article 8 and particularly Article 9 were much more resilient in terms of their redemptions back in March, April, which is wonderful to see because remember, this is not a quarter or a month or an annual piece. This is a 100-year journey for organizations. This is not about, what are you going to hit for your EPS in the next 12 months. But they're also very active. So these are not passive investors. These are now active funds looking for active investments. And if you're not in that kind of space, then you'll get missed out and they will go elsewhere. But that sort of doesn't mean that, it's perfect either, because we have seen greenwashing is the term that's used for all of it, but the unfortunate byproduct of greenwashing is it falls right back onto the corporate because it's up to us to solve all those problems. And I have those problems, I have those questions myself with my own providers. So I'm the chairman of our pension funds here in Ireland for the organisation. I have those questions with those who are providing us with pension services. Can you assure me over my investment managers? Where are they rated on ESG? Because I cannot see the difference between the organisation I work for and the service provider into me. But greenwashing is clearly an issue. But the organizations kind of get to move past that by saying they've, in DWS's case, fired the CEO and watched the share price fall 13%. That's enough. We get to kind of pick up all the bits behind that and say, okay, how do we now prove even more to you that it's not that? I would say in the case of DWS, I mean, you know, it was a bit disappointing considering they were really difficult to get into their ESG funds. Incredibly difficult. We had to work really hard to get onto their ESG list. And then you find out that behind it, there's something else completely different happening. And you've seen a bit of a backlash. You know, you see what happens in Texas around, you know, don't come to Texas with ESG unless you want oil and gas. And look, you see it in the European Union. Gas is now green again. Nuclear is green because we realize we can't hit our targets without it. So it's really difficult for organizations to kind of pick that starting point around what is my ESG story, because it could be taken away from you in the next 6 months or a year by, no, that's not green anymore. And that's the problem we all kind of sit with. But that sort of doesn't mean we should ignore it, because it clearly is something that's here to stay. And it's clearly something that does present an opportunity for organizations. You'd be really silly to not think about ESG and that world as an opportunity to kind of create value for your organization. You know, these are not hedge funds. These are going to be long-term investors with 7-10-year horizons, not necessarily focused on fixed income, but really looking to align their investment strategies with your goals and ambitions around a net zero target. That's quite different as an investment proposition than something we've been seeing before. And I think it has changed. Like if you go back 3 years, the best performing ESG fund in Europe, 12% of it was oil, tobacco, and firearms. So those days are kind of going, and you can see more and more, and because we know it, because the questions we get in, it's deeper and deeper and deeper. I mean, we spend a lot of time engaging just on ESG with investors. Like if you've got someone like Liontrust on your register, that will be a full ESG conversation every quarter. That is not a conversation about the business. That's about where you are at targets, where you are on your ID&E journey. How do you feel about the net zero? Can you map that out for me? What are the capital allocation requirements for that? It's much, much deeper than, you know, how do you feel demand is. They're valuable conversations, but for CFOs, it's a very, very different world. And so you normally we produce what we call the blue book, which has all the answers in it. That book just got bigger. It's more stuff to learn. But they're better conversations if you find people are engaged. The trick is that side of the house really that informed in ESG? Do they understand it any better than the rest of us? I'd argue probably not. So to kind of summarize that bit, it is part of the investment process now. It is part of the proposition, but the market is beginning to differentiate, particularly around 6, 8, and 9 funds. And people will want to fall into 6 because they think, I just can't get there. That's okay. But if you're targeting 8 or 9, be very clear, you need a credible story and you need to be able to demonstrate that very, very clearly to the market. The unfortunate piece is that, and we see it when we get to standards, it still focuses on decarbonisation and waste reduction. So when are we going to have the conversation about biodiversity loss? You know, because if you think about double materiality, you can't have a conversation about double materiality unless you think about biodiversity loss. So I can reduce my carbon to 0, but if I try and make paper with no water, it's an impossibility. But we're not having that conversation, and it's not part of any of the regulations. So that needs to come. Clarity is going to be key here. Like, nobody's expecting you to solve all the world's problems, just to solve your problems. But you've got to be really clear about what those problems are, and you've got to be really clear about how that path kind of evolves. That's why people kind of look at someone like Shell and go, what's the point in you having a net zero target? You're clearly not in that space. The same with BP got a backlash. It's more, I think, that, you know, they didn't tell that story properly. But the corporate ends up with the conundrum because, you know, if we go back to the EDS and the G, well, you know, there still is a cohort who do want you to run your business for profit, you know, and dividends do form part of the S part of this equation, you know, because our pension funds do rely on Smurfit Kappa dividends to solve their kind of pensioners' daily needs. And the capital markets want ever more governance. So the balance between the ES and G is always tensioned around where the corporate can sit in the middle of that. But then you got to get back to, well, what's your strategy? Your strategy cannot be just to try and solve these problems because they compete heavily, particularly around capital allocation. You know, if you think about capital allocation in any organization, the competition between growth projects and ESG projects is very, very real. So we've just approved a boiler for one of our organizations in Colombia, which will reduce carbon by 2,000 tons. It's massive, 6% of all our thing. But the return on that project is 8%. I could spend 100 million on 20 machines, flexifolder gluers, die cutters, and I'd make returns of 20%. But this is where it has to be real for organizations. Unless you're willing to make those investments and willing to make those investments properly, you will be called out. And so what we try and do is balance that around, if you like, valuing the non-financial parts of our organization through ESG and demonstrating properly that this is part of what we told you we're going to do around net zero, because we have a very clear path to 2030. So it always comes back to clarity, path, evolution, and putting capital behind it. Lisa talked about regulation. I kind of call it the alphabet soup because it is. I mean, SBTI, TCFD, you forgot SASB, ISSB, CSRD, NFRD, CDP. Where do you start? Remember, CSRD is supposed to be for the corporates, NFRD for the investment community, and the taxonomy is supposed to be the bit that makes them speak to each other. That clearly is not the case. Because the taxonomy is not finished, and we're waiting for the society taxonomy, which is going to be here soon, and it just scares the life. I mean, it just don't know what's coming at you, so it's very difficult to find your starting point. When you put all those to one side, I would say to you, though, that SBTI and TCFD are very much table stakes now. If you don't have an SBTI target, you're going to be asked, why not? Why do you not think you can target, in our case, 2 degrees and below? And now we're pushing for 1.5, including scope 3. Because remember, most SBTI targets are 1 and 2 scope. They're not scope 3. So again, does the market understand that kind of bifurcation? I don't think they do. And the timeline keeps changing with competing timelines. So, it kind of goes back to how do you find your starting points? Multiple frameworks, multiple champions of those frameworks. We consider ourselves lucky because we have GRI for 15 years. I'm not looking to start with something. But if you're a corporate who wakes up this morning and thinks, I need to pick a framework, I'm not sure where you start. And it kind of sounds like a grand kind of statement, but we really risk losing sight of what we're trying to do here, which is that the aim of all of this is to ensure that we leave the planet in a better place than we found it, and that the generations coming up have less of a problem to fix than we do. And the real risk for me with something like the ISSB, for example, is that we devolve it into a set of accounting standards that require short-term targets to make sure that you can comply with them, and that organizations really short-term their vision at the risk of not missing. And even more so when you get to the States and you look at the backlash against where the SEC is going because people are afraid of class action lawsuits when they miss their ESG targets. That's not really where organizations want to be. We will never achieve the reductions in targets that we all want to achieve if we're going to limit ambition to your next set of targets in the next 12 months and whether or not they're real or not, and how do you kind of support that. So we need to kind of balance the vision and ambition piece with the reality of the day-to-day. And that's going to be really tough. And this universe, which I won't go into, but we can add another 20 onto this list. They all have different rating criteria. They all have different ways of looking at you. The one thing they all have in common is none of them speak to you directly. So they all just go on the publicly available information, and that's what they base their score on. So if you have a problem in this space, it's going to take you a year to fix it. Because you'll ring up and then you'll find somebody and then they'll say, yeah, we'll correct it next time around, but that's a year. So, and it's the same when you're kind of, with your peer set. So, WSCD came out this week and one of our peers was rated higher than us. And you go back and say, well, why is that? And they say, well, no, they got something wrong. And you go, well, for a year now, they get to kind of dine out on the fact that they're better than me when they're clearly not because of an error in what they had calculated. So it's really tricky. So you're kind of, you've got your organizational goals over here, which is putting capital behind your dreams and ambitions around carbon reduction and net zero. You've got a stakeholder audience of investors who want to talk to you about those ambitions and goals and how you're going to get there. And then you've got the first screen, if you like, for any investor, which is, well, how do Smurfit Kappa rate an MSCI or EcoVadis or ISS ESG or Sustainalytics or Dow Jones? We could be here all day. And then you see like Moody's, Fitch and S&P getting into the game too and buying up rating agencies. but not using it to impact your credit rating. Where they want you to fall is neutral, which is no good for an organization either, because you can't differentiate yourself against anybody else in this space. So it's deeply frustrating at times for corporates. And I feel that for those who are starting out the journey. Not all assurance is the same, right? So we've got an assured report because we take that view with everything. The same as when we launched our bond last year, it's an assured bond with ISS ESG. But of the 100 FTSE 100 companies in that top 100, 90 do not have any assurance over their SDRs. Only 2 have full assurance, and 11 of us have limited assurance over the full report. So not all assurance is the same. Not all starting points are the same. We choose the Paris Agreement because it's the logical place to start. We have a peer who starts at 2009. So when you look at their achievement on carbon reduction over the same years, it looks much, much better than ours until you get into the actual detail. Again, you're back to what's out there is public. So if MSCI scan the Leinster leader and they find a negative story in it, that's going in. You don't get to change it. You can't engage with them because they just don't have the space and time, and they don't have the skill and resource. And also they're in a kind of a bind because they have to be commercial. They got to get paid for what they do. But how's that credible? And the simple reality is that not everybody kind of even looks at the indices for their investment decision, but a lot just do. In that kind of initial screen, do I like paper packaging? Who do I like? I only take companies who are A-rated by MSCI. Therefore, I only look at Stora Enso and Smurfit Kappa, or Mondi and Smurfit Kappa. Or I don't look at Smurfit Kappa at all because they're not in Dow Jones. It's a difficult pitch. So that's all the bad news. The good news is you can fix some of this, right? And so but you got to kind of start that journey. And the way we've chosen to do it, I suppose, is kind of restructure ourselves a bit. You do have to go back to the annual report. They are getting bigger. Now, and as I said to Barry earlier, I still haven't met an investor who said to me, I bought your shares because I read your annual report. However much we like to think that doesn't happen. They buy your shares because they meet you and they like it. That's the reality. But we need them to be able to kind of turn these documents into something more commercial than they currently are, a better selling story. We added 15 pages into the annual report last year. It was all TCFD disclosure. It's not going away. And the year before that was 12, all sustainability. So my belief now is that the integrated report will be the annual report into the SDR and not the other way around. So look, it's getting the timelines right. We used to do the SDR about a month after the annual report. We now do them together because the overlap is so big, it doesn't make sense to leave a gap. But if you don't have a sustainable development report, think about doing one. Because a lot of people will just go there for their information, and you can be data heavy on it, and you can give them everything they want. The tricky bit is where are the people and skills to do this? And I don't just mean in organizations, I mean in the accounting professions too. Like we go back to, we have all the standards, like on briefly there, who's going to audit this stuff, right? So those people do not exist yet. And I know from here and the UK is the same story. So, we were told the ISSB regulations are going to be signed off by July this year. That's not happened, and we still don't have anybody to kind of do it. Now, we've all been around long enough to realize convergence in accounting standards takes about 20 years. So I think we can reasonably expect that a lot of us will be retired by the time ISSB, SASB, and GRI come to any kind of agreement on what the set of standards are. It's going to take time, but they got to start somewhere. We have a system in place, but we got to build a new system for what's coming. Because the difference with this data is not kind of aggregated, consolidated data. If you're looking for carbon, you have to go back to the transaction level invoice of the electricity in your corrugated plant, in my case, in France, and pull their invoices to find out what their carbon usage was. That does not exist in your reporting systems. So you got to figure out very complex ways of trapping that data. So you're going to need systems. Investors will generally look for board level expertise now, and they're right to do so because it's a very complex topic. We're very lucky. We have a lady called Kaisa Haitala who's expert in this area. She's actually on the board of ExxonMobil as well as an activist. Look at a board committee because, again, people will wonder how serious you are about ESG if you're not specifically designing and allocating board time to it. So we've always had sustainability as a function, but we made a board committee about 2 years ago to give it, if you like, direct strategic control over where we're going over ESG. And then the second step was to give the responsibility for kind of implementing everything to me. And when you do all that, stay flexible and agile, because it's all going to change anyway. All right, so it's all going to be different. I suppose I'm just out of time, so I'll go a little bit quicker. The future's now, in the sense that we've already started. You know, the time to start all this stuff was probably 10 years ago. That's done now. What I would say, though, have a pause, sit back as a management team, and think about your own ESG story, because it can only be your story. Don't think about what people are looking for. Don't think about what you're trying to target. Get back to the kind of basics. Think about the positive of your story, but focus on the negatives as well. Because people, like, I have a forestry in Colombia, so I get targeted with deforestation, for example, which is not a thing, actually, because most trees go to agriculture and house building. Know that story and be able to articulate that with some clarity. You know, like, there's no point in being the CFO of an organization if you're brilliant on demand trends, but terrible around carbon reduction targets. You'll be found out. Talk to all your capital providers. There is a differentiating factor here between what you will get for a green bond versus a brown bond now. Most importantly, consider targets that are appropriate. And what I mean by that is we're now beginning to see a small backlash against all those companies who set targets and then beat them in the first year they set them. They clearly, you know, nobody minds. It goes back to my conversation about ambition. You're allowed to be ambitious around your targets. Be credible about how you're going to get there in the journey, but be ambitious on the target. But hitting a target and beating it every single time just doesn't seem credible. And lastly, just some questions for you to think about or take away back to your organizations is, can you actually articulate that story? Like, are you able to sit back and think about what ESG means to you? And you'd be surprised, and I've seen it in some very big organizations I've worked with, that that's not always something they get their handle on, particularly in those industries that might be seen as more the problem than the solution. Is it time for an integrated report? My belief is no, not yet. If you're not going to have a committee, where is it going to sit in your organization? So unless it's at the C level and probably the CEO, you're going to find you're going to get a bit of pushback against how real you are about this. Have you the resources? We don't yet. We have a number of our finance team going off and doing sustainability kind of programs to kind of align the finance function and the sustainability function. We're not there yet. But lastly, you know, if you're a board or committee member, how are you going to get assurance on this stuff? It's really easy for one of the big four to sit in front of you and say, we've done the audit, we have the coverage, here you go. But, you know, the reduction in your carbon equivalents of 2% over a cycle, how do you as a committee member get assurance over that? Because it sort of goes back to, someone made the point, Mark made the point, but it's back to liability. So you need to understand how your assurance comes through. And if you're struggling for a place to start with your purpose. We spent a year mining our purpose, and it was the most valuable thing we ever did in the context of our journey. So our purpose is to create, protect, and care. You'll have a different one. But if you're struggling where to start in your story, start with purpose, because it should drive everything else from that. Thank you for your time.
Thanks, Ken. That was brilliant. I'm conscious we're a bit tight for time, but if there's any questions in the room, I'm happy to take them, or Ken is happy, hopefully.
Kevin, work away. No problem.
Yes, we have one, Margaret. Sorry, yeah, just for the mic. Thank you.
Hi, that was excellent. Thank you so much. Can you hear me?
Yeah.
Ken, I'm interested in your interaction with investors via the Article 9 funds. And obviously we have a way to go in terms of social taxonomy, the finalisation of the environmental taxonomy. But are you seeing that this is going to be a blueprint by which there's no qualitative assessment on the part of the investor or the asset manager in dealing? Because you've talked about that you're aligned on the forestry piece. I'm very interested to see how you're finding that. And do you see this as ultimately not being good for the likes of Smurfit who are on that transition?
That's a fear, right? I think there's two things I'm afraid of. Right? There's lots of things I'm afraid of, but the two things in this particular space, the two things I'm afraid of are that we don't stay ahead as everybody else catches up. So and there's a second piece of this, which is regulation. I believe is absolutely necessary. Before everything else, you need regulation to kind of wash out the greenwashers, because the biggest struggle we have as a corporate is actually people saying, well, here's this target and here's this achievement, and you're way below that. And you're going, well, can we have think about the fact that that's not assured? It starts at a different place and it's not the same. So assurance, I think, is necessary to start that particular process around, is everybody the same? So get the level playing field right. To the part of your question, you're absolutely correct. I think part of the problem here with the NFRD piece is it allows investor sets to kind of just screen very quickly and kind of go, it's a big, let's face it, you take any reporting day, say yesterday, 90 companies reporting in the City of London. How do you kind of find your way through that as an investment proposition, particularly as an ESG house? You go to, well, where are they on MSCI? How do they fit with the taxonomy? Are they in or out? And then you go, yes, and they're in, or no, and they're gone. And you never get to, the problem is you never get to have the valuable conversation around where you sit in that kind of world. That's the big issue. But so, yeah, it is a fear. But then, it's a bit like you got to start now around how you're going to get there. And the problem with the taxonomies is they will still change. And the social taxonomy could be something none of us are expecting at all, which is my biggest fear, I think.
Okay. Ken will be around. Sorry, I'm conscious of time, and we have some online speakers coming up. So, look, I want to thank Ken again. That was brilliant. So, Ken, thank you.
Thank you very much.